Hey guys, welcome back. Alright, so in this video I'm going to be going over how to invest $1,000 into the stock market. Let's jump right into it. Alright, so odds are if you're investing your first $1,000 into the stock market, most of you are probably either going to be very young or have very little money or both. Now, those two things are something you really need to take in consideration when you plan out your investment strategy. Now, depending on how young you are, that's going to drastically change the time horizon that you want for this investment, whether it be, 5 years, 10 years, 20 years, 40 years. It's also going to greatly impact your risk tolerance. Now, a lot of people, when they're younger, they tend to take much larger risks because they know if they blow up their account at the end of the day, it will suck, but it's not going to be detrimental to their world. As you get older, people want to take much safer investments, and they really want to almost guarantee that that money will be there in the future. And when you're young, you really are focused more about making money as opposed to, saving money and just letting it grow slowly. Now, if you're brand new to the stock market and you don't really know what's going on, you probably shouldn't go as an aggressive investor. Now, going as an aggressive investor, you have to really be able to, know what's going on in the industry, really understand what certain news headwinds mean for your individual company and for the market in general. And that's something that most people don't really fully understand until, 5+ years in the market. So the strategies that I'm going to be going over are going to be really focused around people that are brand new to investing and how to really, make sure that you have the best type of experience when going through your investments. All right. So enough talk. All right, so my first suggestion is going to be one that's not even my own. So it's going to be taken right out of The Intelligent Investor by Ben Graham, which is, for those of you who don't know and haven't read this, I highly recommend picking up this book. It is kind of like the Bible equivalent for the investor. Everything you need as far as starting out your journey and really wanting to know what direction you want to go in and how to really grasp the markets is in this book. And it was written by Ben Graham, who was Warren Buffett's professor in college, and this edition has now been revised by Warren Buffett himself, and Warren Buffett calls this by far the best book on investing ever written. So for those of you who are really thinking about getting serious about investing, I highly recommend picking up this book. So anyways, on page 119 and 120, Ben Graham actually goes into a breakdown of different individual scenarios and if they want to start their investment journey, what should they do? And one of them is a young lad about the age of, in his early 20s, that has just saved up $1,000 and plans on adding in $1,000 to an investment every year. And the young individual thinks that he's going to be growing his overall income over the next few years, so he'll be able to put in more and more money over time. So, Ben Graham's suggestion is that as an individual with such a small amount in their portfolio, they really shouldn't try to burden themselves with really understanding everything that's going on in the market and really try to dive very deep into individual stocks and things like that. He believes that, one, because you have so much more going on in your life and you're really, you're looking for your career and a lot of things, whether it be you're going to college or you're just starting your job, you don't have as much free time as you will, once you're definitively in the same rut that you're going to be in for the next, 10+ years. So he recommends that individuals start off their account with anywhere up to from 50 to 75% in stocks. And the stocks that he normally recommends are index funds, because as a new to the market investor, you don't really know what companies are going to make it or break it in the next few years, because you don't know what the common trends are and what you want to see in a company and what you don't want to see in a company. So a lot of this is going to be focused around either blue chip companies that have been around for hundreds of years or they have over $100 billion market cap, or the safer bet is to just go with index funds. Now, for the rest of your money, Ben Graham recommends going into E-grade bonds. So you have about 25% into bonds. And unfortunately, bond yields in our current day and age are relatively low. And that generally discourages a lot of young investors because they want to have massive returns and they're looking at an average of a 4% return over the next 10 years and they don't think it's anything special. However, a lot of investors tend to ignore bonds, but you really need to understand that bonds are kind of your safety net. If we were to go into a recession and the stock market drops between 50 and say 75%, those bonds are still a guaranteed yield. The only time when having a bond is not a good situation is when you run into inflation, because the yield that your bond will be giving you will not meet up with it. However, in our current economic standpoint, we're actually worried more so about deflation. So bonds right now are still a good bet if you're planning on making your portfolio last for decades upon decades at a time. So this strategy is, to the average person right now that's going into the market, they don't want to really see this strategy. They just want to jump in and they want to make a lot of money, and they're not, they have a much higher risk tolerance, and they'll take the risk of losing, say, 20% of their portfolio for the chance of making, say, 30%, 40%, things like that. And while that's completely on your own opinion, this is just what pretty much the father of long-term index fund investing recommends for all of you. I'm going to go into a couple of strategies that I've thought of that are more, suited towards people in the modern era. However, this is just kind of what the man himself says. All right, so let's go on to the next strategy. All right, so the next two strategies I want to go into are the 80-20 rule and the 60-40 rule. So each of these is going to be how risky you are with your overall investment strategy. They are both focused around solely stocks, and it's kind of a, it's the individual investor's preference. So with the 80-20 rule, you're going to have 80% of your portfolio in either index funds or in safe blue chip companies that have been around for a very long time. They pay a dividend, and that 10 years from now, this company is definitely going to be a massive company as it's been on. So companies like, say, for example, Coca-Cola, Microsoft, Apple, anything that, you've seen, your parents grew up with, you're sure your kids are going to grow up with, those are the types of companies you want in your safe stocks. Banks also a lot of times fall into that because it's really hard for banks to really get uprooted. And now the other 20% of your 80-20 is going to be more on the growth, more aggressive vesting. So for example, this is where like the Facebook would lie in, the Google, the Amazon, things that are kind of exploding with revenue growth. They don't have as long of a track record as other giant blue chips are, or they could be companies that are smaller market cap, such as like iRobot, GoPro, and all those things that have, they're only a few $1 billion, and, depending on their next few years, it could make or break the company, and it could turn them into a huge market cap company, or it could completely bankrupt them. And you really only want to be, for this strategy, you only really want to be, risking, per se, about 20% of your portfolio. The 60-40 follows the exact same preferences, but it's more for the person that wants to be more involved in their investments and really try to figure out what stocks are going to really make an impact over the next few years. And so that will allocate about 40% of your portfolio to it. But for both of these, especially for new investors, the majority of your money should be in safe, dividend-paying stocks or in index funds because, frankly, you aren't going to know what's going to be the next make or break company every time. You might get lucky, you might get a few stocks, but if you really just try to divvy up your portfolio and say 5 stocks, odds are most of those stocks are going to tank or they're not going to perform as well as the market when you're a new investor. So this is all just kind of getting your feet wet and, having a little bit of risk and, like taking a little bit into your own hands, but really just trying to ride out and see what the market does to learn for when you accumulate larger amounts of money. All right, the last strategy I'm going to be going over is one taken directly from my personal favorite investor, Peter Lynch, and that is invest in what you know. So this strategy, Peter Lynch actually has tested out many of times with individual small colleges and high schools across the nation, and he will ask, groups of students that are interested in the stock market to make a portfolio based off of the companies that they are most comfortable with and the ones that they know. He recommends that they pick a minimum of 5 and a maximum of 10 companies, because anytime below 5, you're not diversified enough, and anything above 10, you're kind of throwing in companies, and you don't feel the same way about the 11th company as you do about, say, the first. So Peter Lynch was very successful with this strategy. He averaged a 29.5% yield for over 30 years while managing the Magellan Fund at Fidelity, which is kind of unheard of, and he's one of the best fund managers of all time. But he truly believes that the average investor can beat out the stock market as long as they only invest in companies that they know. If you're a surfer and you invest primarily in surfing companies, you are going to do better than the average person on Wall Street that is trying to learn little tiny things about all the hot stocks that everybody already knows about, when you're going to know what's the next big surfing company before Wall Street does, and you're going to be able to get massive gains off of your insider's knowledge. So for this strategy, I would recommend, you pick anywhere from 3 to 5 major industries that you really enjoy. And then you pick the biggest companies that you think of. So for example, fast food, you could throw down McDonald's. And then for technology, you could throw down Apple. And for retail, you could put down, say, Nike, and then you can put down American Eagle. For beverages, you can put down Coca-Cola. For banks, you can throw down, like, say, Bank of America or Citizen Banks, whichever bank is your own, and kind of build around your entire portfolio of the companies that you find yourself and the people around you using in your daily lives. Because at the end of the day, behind every stock is the company itself. And the most important thing for the company and the stock's future are the consumers. If you know that everybody around you loves wearing Nikes and Jordans, and you know that that is kind of a safe bet for footwear for the next 5+ years, odds are Nike is going to do well in the next 5-10 years as a company, because over 70% of the entire economy is just based off of consumer preferences and consumption. So if you know what everybody's already going to, odds are you can beat out the market by only sticking to companies that you know have a surefire way at keeping in popularity in the future. Now, this strategy does take a little bit more research, and Peter Lynch advises that the average person that doesn't want to make investing their own job to kind of keep it in between the 5 to 10 rule, because if you really want to keep on top of all of these companies, you're going to run out of time. An average person, if you want to invest, 5 to 10 hours a week, which honestly isn't a lot for investing, if you want to invest that amount of time into just keeping up with your companies, you can do that safely in, say 5 companies. The second you branch off and you start investing in 15+ companies, if you really want to do that much extensive research, that needs to become your own job. Peter Lynch averaged over 100 stocks in all of his portfolios, and he would be working between 60 and 80 hours a week just keeping up with those investments. So this is kind of the most intuitive strategy, and if you really want to get your feet wet and really test the waters on your own personal investment strategy, this is the one I would recommend. Obviously, don't get discouraged if some of your picks or any of your picks don't make it. As long as you can, in the grand scheme of things, really look at your portfolio and you have above a 60% accuracy rate, you are an outstanding investor. You are better than the average investor on Wall Street. And another thing to keep in mind is that when you invest in a company, don't really look at it for the next couple months. Like, the stock price could go up, it could go down. Unless you're trading, which I don't recommend for a new investor, you're only looking at long term. You don't care if the stock goes down 10%, up 10%, or whatever in the short run, because you're banking on it to still be around, years and years from now. And if you keep looking at your portfolio and it does go down, a lot of people sell under fear and they think they made a wrong choice. But, you can have, like, say, Microsoft. Microsoft could go down 10% because the entire tech industry goes down and things like that. That does not make Microsoft now a bad stock. It actually makes it on a discount. So if you really want to stick close to your investments, you would actually want to buy more as it drops, because now you're getting it at a discount. And if you were still banking on it being worth more than you bought it for 5 years from now, now you're just getting a 10% discount. So that's kind of an overall basic introduction to a couple of different strategies. There are thousands and thousands of other ones, and everybody's going to come up with your own individual little niche to follow along with. But these are just a couple of investment strategies that I think as a new investor, you should really take time to consider which one meets your financial goals, and, you know, given your time horizon, which one is going to give you the best yield. All right. So if you guys have any other strategies that you want me to talk about, you know, just let me know in the comments below. If you have any companies that you guys are interested in, or any, you know, big tech trends that you think are going to be really important, you know, just throw them down in the comments. I'd love to hear your feedback. I'll try to answer to every comment that I get. We can go back and forth on different, you know, investment strategies or different ideas and things like that. So yeah, hope you guys enjoyed the video. If you did, give me a like. If you didn't, give me a dislike and tell me why in the comments so I can change my videos in the future. And if you enjoy the content here, you know, hit the subscribe button, and I'll try to pump out as much content for new investors as I possibly can. See you guys.